In today's first panel, we plan to discuss the transformation of risk, of continuing the discussion in many ways, in all its dimensions, led by a group of interdisciplinary experts, including the moderator, who is David Walmsley. David has served as the Globe and Mail's 12th editor-in-chief since 2014. It seems shorter than that, David. Under his leadership, the newspaper has won the annual Missioner Award for Meritorious Public Service Journalism 3 times and has dominated the annual National Newspaper Awards. He is a member of the World Editors Forum of the World Association of Newspapers, and he is also the most recent past chair of the Canadian Journalism Foundation and is currently a governor of the Long Run Institute. So David, a very warm welcome and thank you for joining us today. Look forward to panel one, especially with the springboard of Neil's very interesting comments and conversation.
Thanks very much, Lawrence and Pat, and welcome to everyone for this first panel. It certainly is going to build on the conversation that we've just heard with Neil. It's always frustrating when you have a conversation or you hear a conversation and you have to agree with everything that's said. Sort of my general nervousness is anyone who has certainty on anything makes me very uncertain, especially in the current environment. So it's a delight to be here and to host the conversation over the next 45, 50 minutes or so. I wanted to introduce the panel, 3 very distinguished people who are going to, I think, inform us on the subject of the panel. As Lawrence said, it's the transformation of risk and what that means. So to introduce the panelists, we've got Caryl Athanasiu, who serves as an independent board director of Varo Bank and its holding company, Varo Money. She established and chairs the Audit and Risk Committee and has been part of Varo's evolution from its earliest days. Previous positions include Senior Advisor in Risk Management and Payments at McKinsey, and Executive Vice President and Chief Operational Risk Officer at Wells Fargo. Selected by American Banker as one of the 25 most powerful women in banking, Caryl has served on the U.S. Department of the Treasury's Financial Research Advisory Committee and is Vice Chair of the Board of Directors of the ORX Association. Caryl has a master's degree in management from Stanford University, where she was a Sloan Fellow. Our second panelist is Dr. Warren Hatch. Dr. Hatch is the Chief Executive Officer of Good Judgment Incorporated, a global network of super forecasters, I love that word, who help clients quantify subjective risks for better decisions. Dr. Hatch's prior career was on Wall Street, where he started at Morgan Stanley before co-founding a boutique investment firm. Dr. Hatch holds a doctorate in politics from Oxford, a master's in Russian and international policy studies from Middlebury Institute of International Studies at Monterey, and a bachelor's in history from the University of Utah. He is also a CFA charter holder. And Dr. Cosimo Pacciani is a risk and finance professional with over 24 years of experience serving in public and private financial institutions. Recent positions include Group Chief Operating Officer of Algebris, a British mid-sized asset manager, as well as being Chief Risk Officer for the European Stability Mechanism. With the Royal Bank of Scotland, he held positions as Chief Operating Officer for the Group Credit Risk Function, Head of Risk and Compliance for the Asset Protection Scheme, the mechanism established to rescue the British banking system. Now, that's not a bad sentence for your resume. So Cosimo was working to rescue the British banking system. And he's also was also head of credit risk for corporate and public institutions in Europe. Cosimo is currently advising the Italian government on sustainable financing for long-term investment and advising a new UNESCO initiative on artificial intelligence. He holds a PhD in economic sciences from the University of Siena and a master's degree in economics from the University of Florence. Welcome to the 3 of you, and thank you for joining us. Each panelist will be given 5 minutes to set out their views on the subject of transformation of risk. And a reminder, of course, that we're hosting different perspectives today from the corporate side and public, academic, and that is, of course, by design. After each has had 5 minutes to set out their story, we'll then go to a set of questions related to the subject that I will pose. So I thought that perhaps we could start off, Caryl, with you and give you 5 minutes on the transformation of risk. Thank you.
Hello, everyone. Thanks so much for the opportunity to speak here. I'm going to keep my remarks brief. I find the concept of the transformation of risk an interesting one because in many ways, the risks are not new. They are evolving. The pandemic, for example, which has really kind of dominated all of the risk context for the last few years, was not a new risk. We've had pandemics previously. And in the 2006 World Economic Forum Global Risks Report, for example, an influenza pandemic was actually identified as one of the key risk scenarios. And they were quite prescient in their description, saying if person-to-person infection were to become commonplace, the vulnerabilities of our interconnected global systems would intensify the human and economic impact. A lethal flu, its spread facilitated by global travel patterns and uncontained by insufficient warning mechanisms, would present an acute threat. Short-term economic impacts would include severe impairment of travel, tourism, and other service industries, as well as manufacturing and retail supply chains, all of which we experienced in the last couple of years. Climate change, which is also dominating a great deal of our conversation and focus, is also not new. As Neil mentioned, it's been, in the conversation for a quarter of a century, and the IPCC working groups began publishing reports in 1990. In 2007, at the fourth IPCC report, John Holdren of Harvard said we basically have three choices: mitigation, adaptation, and suffering, and that really hasn't changed. So what I think is different about transformation of risk is the conversation that we're having around it, as it's becoming increasingly apparent that what we're calling these new risks is really the evolution of uncertainty into risk and then risk into threat. And in a world where we have limited resources that we have to choose when we're going to apply and focus, these new risks as threats are now something that demand our attention. So what are some of the characteristics of these risks? They are not as easily understood or responded to in a traditional risk management approach that's been used, especially by financial institutions. And what I mean by that is they're not easily quantifiable. Neil mentioned this earlier, right? The uncertainties piece. And because they're not easily quantifiable, it means we can't really buy them and sell them. They're increasingly difficult to insure because these risks in many ways are macro, right, beyond the economic impacts that financial institutions are used to addressing. They can be intensely disruptive, and as was pointed out earlier, in some cases existential. They're often largely operational in nature, meaning that we are dependent on processes, on people, systems, right, external events. Neil spoke about the concentration, and historically in financial services, we've thought about concentration risk, again, in economic quantifiable terms. I've got too much of this type of credit, I've got too much of that geographic exposure, industry exposure, and who's going to buy it from me? But in this new world of more operationally concentrated, it's concentrated in systems, it's concentrated in digital and cloud computing, and it's even concentrated in extreme weather events that are bigger, broader, more extreme than have happened in the past and have knock-on effects. So the fact that these are concentrated in ways that are networked and different than in the past also makes them susceptible to information and cyber threats. Because many of these are also networked or are macro in ways that we are not used to dealing with, it's difficult to discern the second, third, fourth order effects and unintended consequences. And they often have a tipping point beyond which the risks grow exponentially. Think about the comment that Neil made about having circuit breakers in some of these. And it really is a case where not understanding and being able to stop something early enough means that you're going to have a much bigger problem later. So when I think about these risks and how to kind of what is fundamental underneath them and how to address them, a foundational aspect is extreme execution risk. So here again, Neil was speaking about this earlier in terms of the response to the pandemic, where we have great plans that are not executed well. So if you're living in a world of uncertainty and you have risks that can't be quantified and sold, you do have to do a much better job of understanding the practical aspects, understanding the details, doing what you can to build resilience, and also have very good responsive plans for when the incidents occur. And with that, I'll turn it over to the rest of the panel and look forward to questions and conversation.
Thanks very much, Caryl. There's a lot in that we're going to build on, especially around our ability to maintain resilience amid the second, third, and fourth effects and the unintended consequences that you make mention to. Let's go to our second panelist, Warren. If you could give your opening 5 minutes, please.
Sure, thank you. And thank you for inviting me to join what's already a really fascinating, stimulating conversation. And Good Judgment is the commercial spin-off of a research project that was led by Professor Phil Tetlock at the University of Pennsylvania. And the task, it was a U.S. government-sponsored competition to see if there are ways to improve forecasting accuracy for individuals and teams and improve on the wisdom of the crowd by using probability estimates. And it was very successful. And he wrote about it in a book with a great snazzy title, Super Forecasting. But I was also really thrilled to hear Neil Ferguson talk about Frank Knight's framework of risk and uncertainty, because that's very much the way we also approach the world, where risk are things that you can measure, uncertainty is what's more unknown as we think about an uncertain future. And one of the things that we've been finding is, at least on certain types of topics, that by applying these processes, and that's what super forecasting really is, it's a process, you can do two things in that kind of framework. One is you can get more granular in the way you measure and think about risk by using specific probability estimates, using numbers rather than language. You can aggregate, you can compare, you can keep score, as we have done for a decade now, for thousands of forecasters, some of them the super forecaster elite, across thousands of questions on geopolitics, macroeconomics, and even more narrowly defined finance-related topics that we've been turning to. So, like, will inflation in the U.S. be a transient blip, as the Fed says, or is the U.S. economy overheating and it's going to come back with a vengeance, like Larry Summers says? These are the sorts of topics that we tackle. Will there be another wave of COVID? When will, what does the development of vaccines look like? And we can get very granular as we think about those topics on a year or two time horizon even. But the other thing we can do that we've been finding is we can move the slider. The amount of uncertainty that we can actually measure as risk is more than a lot of skeptics had thought, more than we had thought. And we can especially do effective work by connecting to other tools that are out there, especially scenario analysis, where scenario analysis is very good, time-tested way of thinking about all the possible worlds we might be in, or even the plausible worlds. But where we can come in is, well, which of those worlds are more possible, probable, by attaching probability estimates to what we call clusters of questions that will tell us something meaningful about the bigger scenario. So it'd be, for instance, I think fascinating to take up Neil's Cold War II scenarios and turn those into testable propositions and evaluate which are more probable for the financial risks. Will there be something going on with Taiwan? These are all things that we can tackle with specific probability estimates to better inform policy decisions and public debate. So maybe that's something we might be able to work with on at the future too. Let me hand back over to you. Thank you.
Thanks very much, Warren. To Cosimo, would you like to take your 5 minutes, please?
Thank you very much, first of all, for an invitation to this panel. I'm very honored to be here today. And as Italian, coming from a country that had 66 countries, government since the Second World War, I would say uncertainty is something I grew up with a sense of uncertainty about, governments, but also financial, economical climate and society changes. So to some extent, is to say, I think that from my point of view, I would say I'm kind of used to the concept of uncertainty as let's say nearly as a value or something to appreciate, in a sense that if you look at the way in which we look today at risk management, I think is more akin and more closer to how we should look at also the changes that are happening, because the experience of the last 2 years have been one of a series of shocks. The system, I call them micro shocks. None of them was able, apart from the pandemic, obviously was the big one, but also the others that followed, were not able to topple the system completely. But at the same time, I think they started educating people about risk management, its relevance. I remember my first day in Royal Bank of Scotland in risk team. When I arrived there, I'm talking about 20 years ago, I was the youngest one in the room. And my boss, my German boss, he brought me into a room, he told me, no worries, these are people, or there is gray hair there because they will help us to manage. And I think the evidence now, when you look at the state of the world, things are happening. Also, what Professor Ferguson was saying before, is that we are seeing an acceleration or a series of trends and a series of changes that are happening all together. So I would say that from my point of view, uncertainty, I see more and more like a value that we should endorse and live by, because I think it's only getting used to micro shocks and the capacity to address these kind of situations that will help us to build, let's say, more resilient economic system. We're going to talk about it today, but also to understand more what are the deeper changes in society that are happening. I'm going to speak about it later on a panel, but from my point of view, I think the coincidence and concurrence of a series of trends are really preparing us for a huge and bigger change ahead. That is about how we use technology, is about how we are considering climate change or environmental matters into our own even financial side, on our bond insurances, etc. And also, I think what happened in the last 2 years, and also what happened, to be honest, also during the last financial crisis, is helping us to understand that controls, and they should not be, let's say, I would say we should avoid what Professor Powell, professor from LSE, described like the dictatorship of controls. And we need to understand what are the key drivers, the key elements that we need to really understand more in order to build what we discussed before, with kind of resilience plans, understand what are the real drivers that will help us to go through the next crisis that we don't know where it will come from. We don't know if it will come from the second Cold War, if it will come from an exacerbation or increase of climate change trends. We don't know if it will come from another financial crisis, Chinese real estate crisis, or maybe another ship stopping the flow of cargoes through the Suez Channel. There was another amazing event of this year. It's not long in time, but it also show a lot of fragility of the system, especially on this side of the world. So from my point of view, I would say uncertainty is a value per se that will help us. I always have this image of risk management like a dial, where you have risk management, so the things you know you can manage. Then you have uncertainty, things you're learning how to manage. And then you have panic. And the role of a risk manager, also in my experience, is trying to move this dial from panic through uncertainty back to what you can manage, able to do it with your own, or to accept. Because another element that we see more and more coming is the fact that we need to start accepting some risk. Some events will happen, and we need to have what Professor Ferguson was describing before, some kind of a container, some kind of a headroom. Learning very well from a financial risk point of view, going to speak, I hope, later a bit about this aspect. But I think we need to learn how to do it in other areas, because also the answer to the pandemic has been, from my point of view, somehow good to mitigate the financial risks, but for the health crisis or the answer, how things have been addressed in a, say, incoherent way across the planet, I think increase the problem. So from my point of view, I think I would say it's about uncertainty, and the role of whoever is managing risk should become more of what, again, Professor Powell describes like the role of a chief ignorance officer. I think is that we need to understand that we live in a very, very uncertain world, and we need to learn, be more from all the antennas that we have now there. So much data, so much information, but then what is the relevant and important information for us? How we can distillate what really matters for our organization, for our institution, or for our society in front of this huge white noise that we have in front of us. So what is helping us to drive and we did it very well again on the financial side, because I remember when we were rescue Royal Bank of Scotland, we started to collect 58 data points for each asset that we were managing. Talking about we managed something like a few million assets. And then when we ended up the program with the government, we were just checking 5 piece of information for each loan or for each asset. We're like nominal amount, the expected loss, etc. So the key ones, because we learned through the process that all the rest was background noise if compared to what would matter to us. And I think it's a big job because today we have too much information, and it often is not structured. So really the question is what to weigh through uncertainty that we need to accept as a value is helping us take our decisions. So I think I will stop here for a moment, but I'd like to continue this discussion with other panelists.
Thanks very much, Cosimo, and thanks to the three of you. It's almost we're all vying for chief ignorance officers roles here, where the people who are the ones in the room who are willing to put their hand up and say I don't know are the rarest commodity of all. And indeed, one could argue that of all of the points that have been raised throughout the last sort of hour and a half that we've been talking, they're all at least known. The question that we're asking is the variables within the expected risks. So I'm sure what we're going to find over the next months and years is something that we've not even touched on as being an issue that we're going to have to all respond to. And it raises a very interesting question, that tension in a way from where Neil in his earlier conversation, if we remember, he spoke about what he described as the sclerotic nature of bureaucracy, the inability because of over-formulated responses to things that were not predictable. It meant the government was not really able to achieve in real time what was required. But then if we go to the other extreme, and if we look, for example, at financial institutions in particular, they are rewarded for better or for worse on the short term, on the quarter, on the half, or maybe, good heavens, ambitiously, an entire year. Is that a fatal flaw at both extremes? On the one hand, the sclerotic bureaucracy, and on the other hand, the disease of short-termism that needs to be confronted. And if it can be confronted, what role does history have in trying to force some change and give the people leading the banks permission to go a little bit slower and perhaps a little bit more independent? I'll throw that to everyone. I'm not sure who'd like to start. Caryl, you're looking to the stars, so maybe I'll go to you first.
Oh, well, next time I won't look up. It's an interesting and difficult question, right? So I think that financial institutions, at least through the lens of credit, of extending credit, think longer term, right, than the next quarter, or that, right, you've got an economic cycle, you're doing many of these loans out 20, 30 years, or you've had a very long term relationship with a particular institution or an industry. And so from that perspective, the company is always thinking long term, right? It's also the case that financial institutions are often very large, some of the largest employers, right? And in very expansive geographies. And so there also tends to be longer term thinking, right? From that perspective, how am I going to attract, right, and retain the employees? How am I going to handle that for the longer term so that I've got an appropriate workforce? The places that you start to have the challenges, right, are on the immediate earnings. What am I going to do to cut costs? What am I going to do in terms of my investment portfolio? How am I going to move, right, these things in and out? And so there's an inherent tension, right, there that's challenging. And there's also a tendency from the regulatory environment, honestly, to be more focused on short term. Have you identified all of your risks? Have you, right, as opposed to focusing on threats in the shorter term, the medium term, and the longer term. And so what you wind up with is a situation where you can take on too much risk in the short term financially and not address enough the longer term impacts that are outside of credit, like what are the long-term impacts of climate change? What are the disruptive things that could happen to take me out of the water? And so, again, a tension there. I think it's unfair to say that financial institutions are completely short-term, but what are the controls that we need to put in place or the ways we need to think differently to compensate for the need to make the numbers in the short term? And that's a challenging one, right? Unless the regulatory environment changes, unless the market, right, drivers change, it's very difficult to step away from that.
And Warren, obviously you're dealing with, we refer to the network of super forecasters that you're working with, and Caryl referenced in her opening remarks about the unintended consequences of the interrelated networking of society. Banks in particular are connected as one under that regulatory umbrella. Have you seen any clues to the idea of how the financial institutions can either act as one or can break away responsibly to provide for a better ability to handle the long-term pressures and the unexpected short-term as well?
Well, there's another factor too that we're seeing in the questions that were being asked by clients in the public and private sectors, and that is how the financial system is itself changing, and is it really getting concentrated where the risks of being interconnected are rising, or is it decentralizing where those risks are maybe abating, but other risks are taking their place? Like Campbell Harvey at Duke just put out a book on called was it DeFi, I think it is. I haven't read it yet, but it certainly sounds like that's something that may offer some alternative ways to be thinking about this particular risk. So I think as we think about something like that, rather than starting with a conclusion about what the risk would be, we probably want to throw a broader canvas to evaluate just how material the risk is to begin with. And I think that's an interesting counterpoint to it all, if that's helpful.
Thank you. And Cosimo, you've lived this experience where things have not gone well in certain banking systems, and you've tried to improve conditions. What has been, I suppose, your biggest takeaway in that experience that you think can be held on to for the long term?
In relation to my experience, I would say what matters for an institution, could be a private or public institution, is to have a clear vision accompanying the long-term view, long-term trends. And it could be not only from rescuing the bank, for example, in my experience of Royal Bank of Scotland, or rescue European member states, like with the European Stability Mechanism, but it's to give a sense, let's say, of vision and depth of the changes, meaning that also instilling the idea that it would take time for things to get back right. So to have this kind of long-term or strategic vision is not about that you will see the effects of, for example, labor reform in Greece. You will see the effects of a restructuring on corporate loans in the medium to long term. And this is what we need to get used to. This is where I think the short-termism didn't do any favor at the beginning of the crisis, if you remember, because we were trying to find a fix that was going to resolve issues immediately. What we learned years during the last financial crisis, that is important to have a plan, but also to have the capacity to phase intervention to stop the hemorrhage when it's possible, at the same time to be able to reeducate, let's say, the body to move. And I think for me, what matters as well a lot is human resources, and it's true for any field of activity, but also when you look at management, you look at change management, investing in human resources, in human capital, to be sure that you have the right people, the people that have the right training, right capacity, and endorsement, accountability also to activate the reform or the change or the vision that you have. And this for me, what the big lesson learned. I remember again think about my RBS days or Bank of Scotland. The thing that we decided to do at the beginning was not to get rid of anybody, pretty much to keep people, trying to reallocate them and to use them in other functions in order to help us to go through the crisis. That was, I think, very good idea at the beginning, not to lose the human capital, because with human capital comes also experience that people maturated and created for themselves during the years. So I think it was really relevant. And I think it's the same even now after the pandemic. We need to be sure that everything we learn at the end is encapsulated, not only in papers, but it's encapsulated in people and experiences. Going forward, we need to understand how we can keep this human capital alive for the next, hopefully not, but for the next crisis. So I think they were maybe the lessons that we learned.
Hey, David, can I just add something? So to go back to your original question, which was really about history, right, as well as the short-termism, and we're talking about the last financial crisis because there have been so many of them. Right? And we keep coming up with new ways to lose money when the old ones worked so well. So it's important that's the aspect of history that's important for folks in financial services to remember, right? It's a cyclical business. There are trends. There are commonalities to many of the crises that happened in the past. You don't want to just make sure that you don't have that crisis. You want to understand what the human failings were, what the frothiness signals were, whatever it is, to try to avoid the next one. But critically important to understand that, right, over the course of time, because as long as there have been financial services, there have been financial services crises.
It's you raise a very interesting point there, Caryl, in terms of, I think, where is the starting of the stopwatch for our lessons. It was interesting hearing Neil speak that 57 was an important year to remember with the H2N2 pandemic that came in 57, 58. But of course, many go back 100 years to the Spanish flu pandemic and such like. But if we bring this back to the financial side of things, anyone really who started their career in finance, let's say at the age of 25, they've never seen a crisis that can't be solved by liquidity or by low rates. It used to be said that if you're buying a house 25 years ago, certainly in Canada, that as long as you were getting an interest rate that was below 6%, you were doing well. You were beating the market over the previous 50 years. Nobody really in the last number of years knows anything about a 6% rate. So my question for you, Caryl, is the ready availability of these massive amounts of liquidity and the persistence of low interest altered the DNA of risk takers in the market?
So I'm not practicing in that space right now. So this is just going to be a general comment on human beings, which is absolutely, right? It has adjusted perceptions. So then the corollary has to be, what's the financial institution doing to make sure that that doesn't get out of hand, right? So you might have people at one level who have never experienced the situation, but you should have people several levels above them and approval and control, right, processes that are going to keep you from getting into too much trouble, at least one would hope. But, is it the case that central banks coming in and becoming the buyer of last resort and keeping even more than the low interest rate environment, right? The actions of federal banks, of central banks over the last decade, I think has fundamentally altered, right, how folks think about risk. And it's going to be interesting to see how that plays out now as inflation is probably going to start kicking up in places. So
Thank you. Warren, we're talking a lot about the interconnected elements of one event, catastrophic or slightly less than catastrophic, and then the domino effect that can have. So really, I'm looking at the concept of the polycrisis, the coincidence of different crises or multiple threats happening at the same time. Now, the convergence of such crises has to be, I would imagine, a big part of what this panel discussion is about, which is the transformation of risk in the 21st century. But do you agree that there is such a pressure point on the polycrisis? And if so, what kind of a response from your perspective is required to confront that?
I think in a certain sense, crises are always going on all the time, and I guess what's new and different is how they can become connected very quickly and very rapidly, and the specific risks that kind of connectedness can present. And so the way we would think about it is we would try and identify whether the drivers in those risks do have something in common, and treat it as a testable proposition rather than an assumption. And then to make a deeper evaluation with kind of these scenario tools and the question cluster approaches to see whether there are connections that we should be watching for between potential different crises in the future. So while we may not know what the crises are, maybe we can better understand what the connections are and what the risks of those connections are, and then put in kind of an early warning system to be monitoring whether the probabilities of different crises becoming connected through those network effects is something that requires a more timely policy response, or if in fact throughout history there are a lot of crises going on but they're not necessarily connecting. So that's kind of the way we have been trying to look at some of these things. There's certainly no shortage of security crises and financial crises that do connect, and the example of China and U.S. relations being an excellent example where there are multiple pressure points, friction points that could lead to different kinds of crises without a doubt.
So, Warren, just to stay with you for a second, and it's something that Caryl had referenced about the importance of boards and those who are sitting above the decision makers on a daily basis. If there was one thing that active board members should be looking at, what is it when they ask themselves about how they manage both uncertainty and risk? What is the best advice that you would give them?
I would suggest that when they think about risk is to separate the decisions they're making from the analysis of that risk. Often they do get conflated and do get combined, and there are some reasons that many people think that they should be put together to have so-called skin in the game. But from our perspective, you make better decisions if you have as much as possible unbiased estimates of what the risks are and how material they really are. So I would strongly encourage decision makers generally and boards specifically that when they think about risks is have an independent panel, independent group help them identify and assign the probabilities to those risks being something that they would need to be more concerned about. And then think about the tail risk implications as part of the decision, but at least now they're going to have the best possible estimates of how concerned they should be about those risks. Because we can't deal with all risks all the time. The potential list of tail events and existential risks is endless, and we do need to prioritize, and I think that's an effective way for boards and decision makers alike to do so.
Okay, thanks, because I want to build on that, Cosimo, with you. This idea that on the one hand, a decision gets made or a risk is responded to, and then there are tail effects. There are a lot of issues that stay around, or new things are created from the last crisis. So we all know about the doctrine of whatever it takes on the part of central bankers to try and make risk, if not a thing of the past, at the very least something that is minimized. We seem to believe that government, and certainly the scale of governments have grown, will always be there to declare entire markets, if not in fact entire societies and countries, too big to fail. But there's a price to that doctrine. And I was wondering, do we have to change our thinking about not only that as an expectation, but also our thinking about central bank independence?
First of all, I hope now you hear me correctly, because, okay, good. There wasn't a good example of crisis management. I have to replace my camera on the fly. That was, I hope it works.
All good.
Thank you much for raising that. I would say it is interesting because the whatever it takes doctrine or the intervention, I would say, first of all, in terms of independence or of central banks, this is something that during the centuries, during the last, also say 60 years, changed a lot. There were different cycles in which, even in UK, that started during the Blair government, etc. So there's some kind of sense that we need to have some kind of capacity in the system to have a much more independent capacity to address the issues. They just should be outside of the political decision sphere. Interesting enough, I believe that the whatever it takes decision by Mario Draghi was an eminent political decision from a good point of view, from a good perspective, but it was a political decision because you know that the major impact that this had, that somehow it created the opposite of a credit crunch. It created much more leniency on the system to allow the credit machine to start again properly. And the same problem that we're having now, hopefully, at the end of the pandemic, we are seeing some difficulties, or we're already seeing some problems as soon as the financial support provided by government or central bank will start to wane and reduce over time. So what kind of system we're going to find after? So from that point of view, I think that somehow, again, and we are in a perfect forum, we need to start to think in terms of long-term capacity of the system to generate returns. Interesting enough, I have a book here, is called States of Credit. It's a fantastic analysis of the debt markets in Europe in Renaissance. And it's showing how the city-states, so in Europe, they were more able to get better terms on their financing in the long term than governments on the same period. So the Republic of Florence or the Republic of Siena, they had much better terms for the long-term debt than the King of France or the King of Spain, because they were closer to the returns, to the cash flows. They were more able to manage their own their funds and also their own income and taxation, etc. So from that point of view, I think there are two trends here. One is to think long term, and the second one is to rethink, especially in this moment, we should move into an area where there are with much more indicators to control, is ESG criteria, etc. How we can create a system where there is much more in French we call it partenariat, or collaboration or partnership between the public and the private to reactivate the normal credit channels, at the same time creating new financial products. Well, Professor Ferguson once said that after the financial crisis, we stopped, apart from the SPAC, we stopped creating new innovative financial products officially. Then if you look at the informal area, or you look at the, I would say, at the experience of peer-to-peer lending or microfinance platforms, on the other side, there is much more activity that at the moment is still not able to filter into the mainstream. So the third element is that maybe we should start looking more at what is happening in a society and how people are going about financing each other, crowdfunding, etc., and to apply more to the traditional channels.
One of the, please, Caryl.
Yeah, so I think it's important to recognize that as much as the central banks have expanded what they have done, and it's been important, right, in helping to resolve crises, the crises are still, the fundamentals of the crises are still there, right? The central bank's actions can't get vaccines in people's arms. The central bank's actions can't prevent the next pandemic. The central bank's actions are not going to do anything to really move the needle on climate change. They're not going to help, right, Chinese relations. So I think it's really important for us in financial services, as much as financial services reflect the risks, right, of the communities in which we're operating. It's really important for us to think about what's happening in the real world and not just what's happening on the balance sheets.
And that brings me to a question that one of our participants has asked, and it's exactly along those lines. You know, it's about inequality, it's about polarization, the polarization we're seeing in politics, culture wars, social values, the need to be vaccinated versus citing the Nuremberg Agreement of an individual's person's rights in 1947, that I do not have to put something into my body that I do not want to. You know, there are profound attitudinal pressure points. And to take it entirely away for a moment from, as you say, the systems and put it into the hands of the people, it's going to come down to leadership. Currently, we have representatives of people. I don't know how many leaders we have. A lot of people are turning up at the UN General Assembly, but I'm not sure how much leadership I'm seeing or hearing. We all agree, I think, that leadership is critical. But I'd like to ask each of the three of you, we have about 3.5 minutes left, just each of you to give me your perspective on leadership as you see it today. And are we prepared for all of the risk and discussions that we've been having in order to confront what is going to come at us? Warren, I'll give you some time, Caryl, even though you're looking back at the stars. Warren, let's go to you first, then we'll go to Cosimo, and then Caryl, last word. Warren.
I don't know. Is that? But it's. I think it's not an area that I can speak authoritatively, but I think it's safe to say that empirically, as we look on the recent past, that leadership has not been in fine form, and as we look into the next 5 to 10 years, if anything, the complexity of these risks and challenges that we're facing will be going up, not down. And so I'm sure I, as most others, will be concerned that the leadership response is going to be more challenged than it seems to be up to dealing with, at least on the recent past. Now, to be fair, there's been a lot. It's easy to be a leader in equilibrium when things are very stable, and we have had a disruption over the past year and a half that has upset an awful lot of equilibriums in the public and private sectors. The models that work just fine, they don't. So what do we do about that? And I think one thing that we should expect of leaders is to be searching for new approaches and not just try to return to past models that broke down, and expect them to perform in these future crises that we're facing.
Okay, Cosimo.
I would say, from my point of view, in terms of leadership in these troubled times, the first aspect is two-way communication, or the capacity to be able to interact with what is becoming now an incredibly fragmented society where, to some extent, ideas and views and also fake news as well, they could become mainstream. So I think there should be the capacity leadership to be credible when credible in terms of communication, also in terms of actions, when they implement the plans, where they're able, and they provide consistency to the message. During the health crisis, the pandemic, the worst thing that could happen is that each country in Europe, thinking about the experience here, at UK, because after Brexit, they had different policies. If you think about the UK, there are 4 different policies in relation to Brexit, in relation to the pandemic, how to address this. So communication and coherence is important, also because of the long run. And at the same time, I think together with communication is also the realization that we are going to live in a society that's going to be much more complex and open, but also with many more players. Before we used, I live in Florence, where the Communist Party newspaper was put on a wall in front of a shop, and everybody was gathering there to read the news there. And nowadays you can get news and information from everywhere, and it's creating again the kind of white noise I was referring before. So we need the leadership to be able again to extract what is relevant to people, to address some of the issues that the question raised, inequality and justice, etc. Because we live in a world where everybody not only has ears, but has also the voice and the capacity to interact in public discourse. And this is true for companies, governments, and also for us and people working in this environment. With the addition that the complexities are in the future going to have 2 more relevant players that are nature, because of the financial disclosure we need to look at, and machines, because we need to start to deal with the fact that a lot of decisions will not be taken by people or politicians, but by algorithms. And it's becoming more and more. So this is creating, I know that the center is looking at that one, will become another big issue to deal with when looking at issues like inequality or justice or decision making or lawsuits.
Thank you, Cosimo. And Caryl, a last word briefly, please.
Yeah, so at the risk of ending on a downer, I personally don't see a leader in the current setup that we have, right, that it can really address the big challenges. So I think there's going to have to be an emerging leader. And when I think about that, I think the challenges are twofold. If you're going to be a leader, you have to have a vision that people buy into, but then you have to have successes in executing that vision in order to bring more people in and bring people along. And getting things done in this very complicated geopolitical, right, fake news world is increasingly difficult. And so I think that's the challenge, right? How do you get the right message, but then how do you get enough successes? And how do you deal with that issue of distrust and stop sort of some of the despair that is starting to happen in younger people, right? And the distrust there as well. So we need somebody new. Come on.
Okay. Well,
yeah.
Time will tell whether that's done through democracy or other forces. But I'd like to thank all of you for the intellectual debate, the sparring, the thoughts. I'm sorry it couldn't be longer, but very much appreciated. And I will now hand it back to Dr. Muzio before the break. Thank you, everyone.